Imagine this. It is April, tax season. You sit down at your kitchen table with your tax forms, a cup of coffee, and a pen. You have done everything right your whole life. You worked for decades. You paid into Social Security. And now you are retired, living on a fixed income, counting on every single dollar, and then you see it. A number on your state tax form that makes no sense. Your Social Security income, money you earned, is being taxed, again, by your state, and nobody warned you. You pick up the phone, you call your son, your daughter, your neighbor down the street, nobody knows the answer. That moment, that confusion, that fear, is exactly why you need to watch this video today. Hello, my name is Milena. I am a senior policy analyst and retirement finance expert, and I want you to take a deep breath right now. Because what I am about to share with you is important, but it is also fixable. Today I am going to walk you through a rule that is costing thousands of retirees up to $3,000 every single year, sometimes more, and most of them have absolutely no idea it is happening. I'm going to tell you exactly which states are involved. I'm going to explain the official government rules in plain, simple language. And I am going to give you a 3-step action plan to protect your money starting today. But I need you to stay with me until the very end of this video, because near the end, I'm going to reveal one specific mistake. A mistake that seems completely harmless, that can suddenly make your Social Security income taxable, even if it was not taxable before. This one mistake catches retirees off guard every single year, so please, stay with me. Let me tell you about Robert. Robert is 67 years old. He is a retired school teacher from a small town in Vermont. He spent 35 years in the classroom. He coached the school soccer team. He was beloved by his community. When Robert retired, he did everything the right way. He signed up for Social Security at the right age. He set up his direct deposit. He even called the SSA hotline to confirm his monthly benefit amount. Robert's Social Security benefit was about $1,800 a month, not a fortune, but enough combined with his small teacher's pension to live comfortably. He was proud of that. He had earned it. Then April came. Robert sat down to do his taxes. He had a friend help him, not a professional, just a neighbor who was good with numbers. His neighbor added up Robert's income, his Social Security, his pension, a small IRA withdrawal Robert had taken in December to cover some unexpected home repairs. And suddenly Robert's total income crossed a number, a specific threshold that Vermont uses to determine whether Social Security benefits are taxable. Just by taking that one IRA withdrawal, money he needed for his roof, Robert had pushed himself over the Vermont exemption limit. His Social Security income, which he had assumed was protected, was now partially taxable at the state level. Robert owed the state of Vermont hundreds of dollars he had not planned for. He had no withholding set up. He had paid no estimated state taxes throughout the year, so he owed it all at once, in April. He had to dip into his small emergency savings to pay it. And the worst part? Nobody had ever told Robert this rule existed. Not his bank, not his financial advisor, not even the SSA representative he had spoken with when he retired. Robert's story is not unusual. It happens every single year in 8 states across this country, to retirees who did everything right but were never given the full picture. Let me give you that full picture right now. Here's the truth that most people do not know. The federal government can tax your Social Security benefits. Most people know that. But what most people do not know is that 8 states in this country impose their own separate additional income taxes on Social Security benefits. 8 states. And depending on where you live and how much income you have, that state tax can reduce your annual Social Security income by $1,000, $2,000, or even $3,000 or more. Let me tell you exactly which states these are. The 8 states that currently tax Social Security benefits are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Now, and this is important, each of these states has its own rules, its own thresholds, its own exemptions. So, let me walk you through each one briefly. Colorado. If you are under 65 in Colorado, you can deduct up to $20,000 of Social Security from your state taxable income. If you are 65 or older, that deduction increases to $24,000. Any Social Security income above that deduction is taxed at Colorado's flat state income tax rate, which in 2026 is 4.4%. Connecticut. Connecticut is more forgiving for lower income retirees. If your federal adjusted gross income is below $75,000 as a single filer, or below $100,000 if you are married filing jointly, your Social Security is fully exempt in Connecticut. But if you earn above those amounts, up to 25% of your Social Security benefits may become taxable at the state level. Minnesota. Minnesota is considered one of the toughest states for Social Security taxation. It taxes Social Security in a way that closely mirrors the federal rules. The state does offer a partial exemption, called a Social Security subtraction, but it phases out as your income increases. If you are a higher income retiree living in Minnesota, a significant portion of your Social Security could be subject to state income tax. Montana. Montana generally follows the federal taxation rules for Social Security with very limited exemptions. There is no blanket exemption for Social Security income in Montana. This means many Montana retirees owe state taxes on their benefits, often without realizing it. New Mexico. New Mexico has more generous thresholds. Single filers with income below $100,000 are fully exempt. Married filers below $150,000 are also fully exempt. But above those thresholds, Social Security becomes taxable at state income tax rates. Rhode Island. Rhode Island exempts Social Security if your income is below $88,950 for single filers or $111,200 for married filers. Above those thresholds, your benefits are taxed at Rhode Island state income tax rates. Utah. Utah includes Social Security in taxable income and taxes it at the state's flat income tax rate of 4.55% in 2026. Utah does offer a retirement tax credit, but that credit phases out as income rises. Higher income retirees in Utah may see very little protection from this credit. Vermont. Vermont, Robert's state, begins taxing Social Security at $50,000 for single filers and $65,000 for married filers. Above those thresholds, Social Security benefits are taxed at Vermont state income tax rates. And as Robert learned, that $50,000 threshold is easier to cross than you think. Now let me explain the federal rules quickly, because this is the foundation everything else is built on. At the federal level, the IRS uses a formula called combined income. Combined income equals your adjusted gross income, plus any non-taxable interest, plus 1/2 of your Social Security benefits. If your combined income as a single filer exceeds $25,000, up to 50% of your Social Security may be federally taxable. If your combined income exceeds $34,000, up to 85% may be federally taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Here's what makes this even more painful. Those federal thresholds were set in 1983 and 1993. They have never been adjusted for inflation. That means every year, as Social Security benefits increase and as retirees take more IRA withdrawals and RMDs, more and more retirees cross those thresholds and become subject to federal taxation. And then, on top of that federal tax, if you live in one of those 8 states, your state adds its own tax on top. That is double taxation on the same income. Now, do you remember I told you at the beginning of this video that there was one hidden mistake I would reveal? Here it is. This is the mistake Robert made. And this is the mistake thousands of retirees make every single year without realizing it. IRA withdrawals and required minimum distributions, RMDs, count toward your combined income. So even if your Social Security was below the taxable threshold last year, if you took a single IRA withdrawal this year, if you took an RMD you were required to take, that additional income can push your total combined income over the threshold. Suddenly, Social Security benefits that were previously exempt, federally or at the state level, become taxable. This is not a loophole. This is not a glitch. This is exactly how the law is written. And it catches retirees completely off guard every single year. Oh, Before I give you your action plan, I need to mention one more important development. If you are a former government employee, a teacher, a postal worker, a firefighter, a police officer, you may have heard of the windfall elimination provision and the government pension offset. These two rules used to reduce Social Security benefits for people who receive pensions from jobs that did not pay into Social Security. I want to be very clear about this. Both of those rules have been repealed. The Social Security Fairness Act was signed into law on January 5th, 2025. WEP and GPO are gone, and if your benefits were previously reduced because of those provisions, you may be entitled to retroactive payments going back to the date of repeal. The SSA is actively processing retroactive payments for eligible individuals, but here is the critical part. You need to contact SSA directly to confirm your eligibility. Do not assume the money will automatically appear in your account. Call SSA at 1-800-772-1213 or visit SSA.gov and search for the Social Security Fairness Act. Do not leave money on the table that is legally owed to you. All right, now that you understand the rules, let me give you 3 concrete steps you can take right now to protect your Social Security income. Step 1. Find out exactly how your state taxes Social Security. Today. Do not assume. Do not guess. Do not rely on what a neighbor told you 2 years ago. State tax laws change. Thresholds change. Exemptions change. Go to the AARP state-by-state Social Security Tax Guide. Visit aarp.org and search for which states tax Social Security. Look up your specific state. Find out the income threshold that applies to your filing status. Then calculate your total combined income, your AGI plus non-taxable interest plus half of your Social Security, and see where you stand. If you are close to a threshold or over one, you need to act now. Step 2. Arrange for tax withholding from your Social Security payments. Here is something many retirees do not realize. Federal income taxes are not automatically withheld from your Social Security check. You have to request it yourself. You do this by filing IRS Form W-4V, the voluntary withholding request, with the Social Security Administration. You can choose to have 7%, 10%, 12%, or 22% of your monthly benefit withheld for federal taxes. Choose the rate that best matches your estimated federal tax liability. But here is what is critically important, and what Robert did not do. Federal withholding does not cover your state income taxes. If you live in one of those 8 states, you must separately arrange for state tax withholding, or pay quarterly estimated state taxes throughout the year. Contact your state's Department of Revenue. Ask them specifically what form you need to arrange state withholding from your Social Security or pension income. If you do not do this, you could face penalties and a large unexpected bill every April. Step 3. Get free professional tax help from AARP Tax-Aide. I want to say this clearly. The tax rules around Social Security, federal and state combined, are genuinely complicated. You do not have to figure this out alone. AARP Tax-Aide offers completely free federal and state tax preparation services for seniors age 60 and older. Their counselors are trained specifically on state-by-state Social Security taxation rules. They know the thresholds, they know the exemptions, they know how IRA withdrawals and RMDs affect your tax liability, and it is completely free. Visit aarp.org and search for Tax-Aide to find a location near you. If you are in one of those 8 states, or if you are unsure whether you might owe state taxes on your Social Security, please use this resource. It could save you hundreds or even thousands of dollars. Before I let you go, I need to say something important, and I mean this from the bottom of my heart. I know that many of you watch videos like this one and feel relieved, you feel informed, and you tell yourself, I will look into this later. Please do not do that today. The rules I have shared with you are real. They are official. They are costing real retirees real money right now. Robert lost hundreds of dollars he could not afford to lose, not because he was careless, but because nobody gave him the full picture. You now have the full picture. Now, I want to be honest with you about something. YouTube notifications are not reliable. Sometimes you subscribe to a channel and the notification never comes. You miss a critical update. You miss a rule change that affects your benefits. That is why I want to personally invite you to join our global Senior Alerts official WhatsApp channel. The link is in the description below this video. When you join, you will be able to download our free Senior Benefits Protection Guide, a complete plain language reference that covers Social Security taxation rules, Medicare changes, pension protections, bank rules, insurance policies, and travel regulations, all in one place, all in language that is easy to understand. And when important rules change, like the repeal of WEP and GPO, you will be among the first to know, directly on your phone, in real time. You worked too hard for too long to lose money because of a rule nobody told you about. Join the channel, download the guide, share this video with a friend or family member who is retired or approaching retirement. Because the person sitting next to you at church, or across the dinner table may be losing money right now and have no idea. My name is Milena. I will see you in the next video, and until then, protect your benefits, protect your income, and please, take care of yourself.